What if the most important financial shift of this decade didn't arrive with a crash, a crisis headline, or a dramatic emergency meeting, but quietly, through vault doors, balance sheets, and a market signal most people stopped paying attention to years ago? Because that's exactly what may have happened. And almost no one noticed it in real time. Over the past few months, a handful of analysts have been pointing to something unusual, something that hasn't shown up consistently in decades. Not a price target, not a technical pattern, a structural signal. On October 2nd, something changed in the precious metals market, and it wasn't just another volatile trading day. It was the kind of shift that only becomes obvious after the fact, once the consequences are already in motion. Silver did something it almost never does. The physical metal began trading at a premium to futures contracts, not for a day, not as a fleeting anomaly, but repeatedly. And once you understand why that matters, it's hard to unsee the implications. Before we go any further, let's get something straight. This isn't about hype, price calls, or flashy predictions. There are plenty of channels for that. This is about the plumbing of the financial system, the boring, unglamorous mechanics that determine whether currencies remain stable or quietly lose credibility. Ironically, those mechanics tend to matter the most, right before they stop working, the way everyone assumes they always will. Silver reached $48 per ounce in early October 2025. Most traders shrugged. We've been there before, they said. And technically, that's true. Silver touched similar levels in 1980 and again in 2011. Both times ended badly for anyone who confused momentum with permanence. But this time, the behavior around the price was different. Instead of futures leading spot, spot led futures. Physical silver, the actual bars you can take delivery of, was more expensive than a promise to deliver it later. That condition is called backwardation, and in commodity markets, it's a warning light. Under normal circumstances, future delivery costs more. Storage, insurance, financing, time, all of that adds up. When the opposite happens, it means buyers are willing to pay extra to get their hands on the metal immediately. Not next month, not next quarter. Now, backwardation appeared in October, faded slightly, then returned. Even during sharp sell-offs in early January 2026, when silver dropped around 5% overnight, the pattern reemerged. Spot prices consistently ran 30 to 40 cents above March futures contracts. That's not noise, that's stress. This wasn't a one-off spike either. In previous cycles, silver surged, collapsed, and disappeared from the headlines. In 1979 and 1980, it rocketed to $50 in a matter of months, then crashed just as fast. In 2011, it touched $48 and imploded, taking over a decade to recover. In 2025, silver didn't behave that way. It moved violently, yes, but it also held. It consolidated. It pushed higher again. Prices surged from the $50 range into $60, $70, and briefly above $80. $3 and $4 daily swings became routine. 10% daily ranges stopped shocking anyone. Exchanges raised margin requirements, forcing traders to post more cash just to stay in the game. Normally, that kind of tightening breaks speculative rallies. This time, it didn't. The underlying pressure remained, and the backwardation kept resurfacing during moments of stress. Why? Because this wasn't being driven by speculative leverage. It was being driven by something much harder to fake, physical scarcity. For 4 consecutive years, the global silver market has been running a supply deficit. Mine production plus recycling simply hasn't been enough to meet demand. Industrial use, investment demand, jewelry, and especially solar panel manufacturing have been pulling silver out of the system faster than it can be replaced. Over those 4 years, the cumulative deficit reached roughly 800 million ounces. That's about an entire year of global mine supply. Gone. That metal didn't vanish in a single dramatic event. It left quietly. Ounce by ounce, shipment by shipment, warehouse inventories declined steadily. Exchange vaults reported gradual outflows. Lease rates in London began to climb. Lease rates measure how expensive it is to borrow physical silver for short periods. Rising rates mean tightness. Sustained elevated rates mean the tightness isn't temporary. Here's where things get uncomfortable for the existing pricing system. Silver, like gold, has been priced for decades through a heavily leveraged paper market centered in New York and London. Futures contracts, options, unallocated accounts, claims on metal rather than metal itself. This works as long as only a small percentage of participants demand actual delivery. It's a fractional reserve system in all but name. But when physical inventories shrink year after year, the leverage stretches. The fraction gets thinner, and eventually, the paper promises start competing with real metal. That competition shows up as backwardation, volatility, and mechanical dislocations across global markets. Craig Hemke noticed something else that added to the picture. When trading opened in Shanghai and Chinese exchanges raised margin requirements, prices often fell there first. London would open next, with fewer buyers, and prices would slip further. By the time New York came online, silver could be down 5% without any new information entering the system. This wasn't macro news. It wasn't economic data. It was the physical market in one region influencing paper markets elsewhere. At the same time, governments began moving, quietly at first. In the United States, a notice buried in the Federal Register reclassified silver, no longer just a commodity, no longer simply an industrial input. Silver was designated a strategic critical mineral, a category usually reserved for materials essential to national security. That classification isn't about price support. It's about priority and control. It signals that domestic supply matters more than free-flowing markets. Across the Pacific, China made its own moves. Export restrictions appeared. Not outright bans, but quotas, licenses, administrative hurdles. Silver wasn't alone. Rare earths, certain copper grades, and other critical materials faced similar treatment. Two major economies were effectively ring-fencing their resources at the same time. That doesn't happen casually. Geopolitics reinforced the message. In early January 2026, a U.S. military operation in Venezuela removed President Maduro directly. Whether one agrees with the action or not, it demonstrated something important. Policy statements were being backed by action. When officials said they were serious, they meant it. That seriousness extended beyond Latin America. For years, talk of acquiring Greenland was dismissed as political theater. Then proposals became more concrete. Numbers were floated. What if every Greenland resident received a massive payout? 50,000 people. Even at extreme figures, the math wasn't impossible. The real question wasn't cost. It was funding. And that brings us to the most overlooked part of this entire discussion. The Federal Reserve S balance sheet. The Fed still values its gold holdings at $42.22 per ounce, a price set in 1971 when Bretton Woods collapsed. In early 2026, gold traded north of $4,000 per ounce. That discrepancy represents trillions of dollars in unrealized accounting value. Treasury Secretary Besant hinted at this months earlier, using a phrase most people ignored: monetizing the asset side of the balance sheet, not selling bonds, not issuing new debt, revaluing existing assets. If gold were marked closer to market value, or even substantially higher, the accounting gain could exceed $2 trillion. That capital could fund a sovereign wealth vehicle, finance strategic acquisitions, or recapitalize parts of the system without traditional money printing. In that context, silver's behavior looks less like a speculative frenzy and more like an early signal. Physical metal tightening, governments prioritizing resources, balance sheets being quietly repositioned. The question isn't whether precious metals reach certain price levels. The more important question is, what happens to currencies when they do? That's the part most discussions skip. And it's the part professionals should probably be paying attention to, preferably before it stops being boring. At some point, the truly consequential ideas stop sounding outrageous and start sounding familiar. Buying Greenland once seemed like late-night satire. Extracting a sitting president from Venezuela sounded even more far-fetched, right up until it happened. Once you recalibrate for that reality, a lot of recent policy moves start looking less chaotic and more coordinated. By late 2025, the broader strategy around resources was no longer subtle. The drill, baby, drill language wasn't about bragging rights or energy independence alone. The United States was already the largest crude oil producer on the planet. This was about accumulation, about stockpiling, about ensuring domestic access to critical materials in a world where trade flows could be interrupted, not just by markets, but by geopolitics. Uranium programs were quietly expanded. Rare earth mining on federal land was fast-tracked. Copper production was elevated from an industrial concern to a strategic priority. And silver, long dismissed as a relic or a speculative cousin of gold, suddenly found itself on the same list. Not because of nostalgia, but because silver sits at the intersection of electronics, solar energy, medical technology, and advanced manufacturing. You don't build a modern economy or a modern military without it. China was doing the same thing from the opposite direction. Export restrictions tightened. Licensing requirements multiplied. Domestic reserves were built up. The message was simple. Chinese manufacturers would get first claim on Chinese resources. This wasn't ideology. It wasn't Cold War rhetoric. It was supply chain warfare, and it was unfolding in real time, without speeches or dramatic announcements. Craig Hemke noticed that this shift wasn't isolated to precious metals. Copper surged to $13,000 per ton in London, an all-time high. Copper isn't a speculative toy. It's wiring, construction, machinery. When copper hits record prices, it signals that industrial users are worried about availability, not just cost. And copper wasn't alone. Similar stress patterns were showing up across multiple commodities simultaneously. This wasn't just inflation. It wasn't just monetary policy. Governments were actively removing supply from global markets, either by restricting exports, prioritizing domestic use, or classifying materials as strategic. And once a resource earns that label, it doesn't quietly go back to being just another commodity. Strategic status is a one-way door. For For 4 years, central banks had been buying gold at a record pace. Hundreds of tons per year flowed into official reserves. China, Russia, India, Turkey, and a long list of emerging economies steadily converted dollar reserves into physical gold. Now that mindset was expanding. Silver and industrial metals were being viewed through the same lens. This wasn't confiscation or nationalization in the dramatic sense. It was control through classification and policy. That created a problem for the existing pricing system. Since the mid-1970s, gold and silver prices have been set primarily in Western exchanges, New York and London, through futures contracts and derivatives. The system assumed abundant physical metal and free global movement. Leverage was extreme. In some cases, there were dozens, even hundreds of paper claims for every ounce of physical metal. That system works beautifully, right up until physical metal stops moving freely. When governments interfere, when exports are restricted, when stockpiling replaces selling, leverage stops being theoretical and starts being dangerous. The strain shows up as backwardation, volatility, and dislocations that technical analysis can't explain away. Hemke's outlook for 2026 wasn't built on chart patterns or momentum indicators. It was built on observing behavior. Governments were telling markets, through actions rather than words, that access mattered more than price. And when access becomes the priority, price becomes a secondary variable. Gold's behavior since early 2024 illustrated this perfectly. When gold broke out to new all-time highs in March 2024, it didn't move randomly. It followed a rhythm, roughly a 20% advance, followed by 2 to 4 months of consolidation, then another 20% move. Not a blow off top, not speculative mania, a methodical progression. By summer 2025, gold was trading around $3,500 per ounce. But Hemke was watching the floor, not the ceiling. Support held. There was no waterfall decline back to prior levels, just patient accumulation at higher prices. By early January 2026, the next phase was setting up. Another 20% from $4,200 pointed toward $5,200. Consolidation through summer, then another leg higher. $6,000 by year-end wasn't a fantasy. It was pattern recognition applied to observable behavior. Silver followed a different path, but with parallel logic. Gold took roughly 21 months to double from its breakout level. Silver finally broke above its old all-time highs in October 2025. If silver followed a similar doubling pattern, but on a compressed timeline, say half as long, that pointed toward $100 per ounce by mid-2026. Michael Oliver, another veteran analyst Hemke respected, went further. He projected $100 silver as early as the end of the first quarter. Hemke didn't fully endorse that speed, but he didn't dismiss it either because silver wasn't trading normally. Physical premiums, backwardation, and repeated stress signals suggested something more urgent beneath the surface. One thing, however, wasn't behaving as expected. Mining stocks. Traditionally, when gold and silver rise, miners outperform. Their profits are leveraged to metal prices. Higher prices expand margins dramatically. Stock prices should reflect that. Instead, the GDX, one of the main gold miner ETFs, was barely higher than it had been months earlier. The culprit wasn't geology or management. It was machines. High-frequency trading algorithms now account for an estimated 80 to 90% of equity market volume. At a certain point, feasibility stops being the limiting factor and precedent takes over. Financing massive infrastructure without officially blowing out the deficit used to sound like a fantasy, until senior Treasury officials went on camera and calmly talked about monetizing the asset side of the balance sheet. Those weren't throwaway words. They were precise, deliberate, and legally grounded. The mechanism exists. The framework exists. The only real question left was whether policymakers would actually pull the trigger. Craig Hemke's answer was simple. Stop asking what they say they all do and start looking at what they already have done. Nobody believed the United States would send special forces into a foreign country to extract a sitting president, until Venezuela. Once that happened, the menu of unthinkable options got a lot shorter. Policy statements weren't theoretical anymore. They were becoming operational. That's why the price targets people were debating for 2026 suddenly looked almost quaint. When Hemke published his 2025 forecast a year earlier, the reaction was brutal. Gold at $3,100? Laughable. It was already at $2,600 after a strong year. Surely it had run out of gas. Silver in the high 30s? Absurd. That required a 30% move while Washington was promising spending cuts. The dollar was supposed to surge, and precious metals were supposed to collapse. The emails reflected that confidence. He was called reckless, unserious, ideologically biased. One memorable note suggested he didn't understand basic arithmetic, which is always a crowd favorite. Then silver traded north of $80. Gold pushed through $4,300, and the emails changed. Suddenly, the criticism wasn't that he was crazy, but that he hadn't been bullish enough. Why only 10% and 30%? Didn't he see what was coming? This is the analyst's paradox. Predict high, you're irresponsible. Predict low, you're incompetent. Get it right, you were lucky. It's a no-win game. So when Hemke published $6,200 gold and $120 silver for 2026, he did it with eyes wide open. The criticism was guaranteed, but the methodology wasn't guesswork. Gold had been following a remarkably consistent pattern for nearly 2 years. Roughly 20% advances followed by multi-month consolidations, each new move launching from a higher base. 4 consecutive cycles. No blow off top, no collapse. Just stair-stepping higher. If that pattern continued, and there was no structural reason it shouldn't, to $6,200 wasn't T optimism. It was arithmetic. Silver was messier in timing, but clear in direction. It had finally broken through a ceiling that had capped it for more than a decade. It was lagging gold, as it usually does, but with far more volatility. If silver completed a doubling cycle similar to gold's 21-month trajectory, but on a compressed timeline, $100 by summer wasn't aggressive. It was reasonable. $120 by year-end was simply the next logical extension. Michael Oliver's call for $100 silver by the end of the first quarter sounded aggressive, but not insane in a market where $4 daily swings had become routine. When an asset moves 10% in a single session and no one even checks the news, something fundamental has changed. Stable commodities don't behave like that. They don't trade in persistent backwardation. They don't force exchanges to raise margins repeatedly. These are symptoms, not anomalies. Symptoms of a pricing system under stress. And nothing on the horizon suggested that stress would ease in 2026. The supply deficit wasn't T reversing. You don't replace 800 million ounces of silver with a press release. Mine supply takes years to ramp. New deposits take a decade to move from discovery to production. The physical shortage was baked in. Government resource nationalism wasn't reversing either. Once silver is labeled a strategic critical mineral, it doesn't quietly go back to being just another commodity. Once China restricts exports, those restrictions become permanent policy, not a bargaining chip. Central bank gold buying wasn't reversing. 4 years of documented accumulation across the developing world didn't happen by accident. Why would those institutions suddenly decide that dollars were safer than physical gold? Geopolitical tension wasn't reversing. Venezuela wasn't an isolated episode. It was a signal. Greenland discussions, Panama Canal rhetoric, Colombia negotiations, these weren't campaign slogans, they were live policy files. Monetary policy wasn't reversing. Deficits north of $2 trillion were no longer controversial. They were explicit. Short-term rate cuts were the plan. If long-term rates resisted, yield curve control was the backup. Treasury officials had said so plainly. Running it hot wasn't a metaphor. It was the strategy. All of that pointed in one direction. Higher prices for monetary metals and strategic commodities. There was one caveat, and Hemke was clear about it. The real risk wasn't technical. It wasn't a chart pattern failing or momentum rolling over. The risk was outright economic collapse. A sudden severe contraction in global demand. Industrial consumption imploding. A deflationary spiral overwhelming monetary expansion. That scenario would push prices lower, but it would require policymakers to do the opposite of everything they had demonstrated so far. The Federal Reserve would have to abandon rate cuts. The Treasury would have to embrace real austerity. Deficit spending would have to stop. Industrial production would have to crater globally. Possible? Yes. Probable? Hemke assessed it as a low probability outcome. Policymakers had shown their preference clearly. Inflation over deflation. Expansion over contraction, risking overheating rather than risking collapse. Choices have consequences, and one of those consequences is higher precious metals prices. The mining shares remained the unresolved puzzle. Gold and silver surged, yet mining equities barely budged. The explanation wasn't sinister, it was mechanical. High-frequency trading algorithms dominated volume. These systems sell miners when futures dip in the first hours of New York trading, regardless of what happens later in the day, regardless of earnings, regardless of fundamentals. The result was chronic underperformance. But fundamentals don't disappear. Mining companies would report earnings, margins would expand, cash flows would surge. At some point, even algorithms react to profits. When that catch-up happens, it rarely happens gently. Years of underperformance tend to compress into months of violent repricing. Then there was the information environment, which Hemke found increasingly troubling. The internet had become saturated with outright falsehoods, claims that COMEX was hours from failure, that JP Morgan controlled hundreds of millions of ounces of silver, that exchanges nearly collapsed over holiday weekends, all demonstrably false, all easily disproven, yet repeated endlessly, often by AI-generated content that recycled the same narratives with minor variations. Repetition breeds belief. Noise drowns out signal. The commodity index rebalancing episode was a textbook case. A non-event, 1 to 2% of daily volume spread over several days, was presented as an existential threat. Banks scared clients. Headlines screamed collapse. Fear generated trades. Trades generated commissions. Exaggeration was incentivized. Hemke's 15 years in the market gave him a longer lens. He'd seen silver spike to $50 twice and crash both times. He lived through 2011. He'd heard every bearish argument and every bullish fantasy. This time felt different, not because prices were higher, but because the structure was different. Physical markets were genuinely tight. Government actions were genuinely constraining supply. Monetary policy was genuinely expansionary despite public talk of discipline. These weren't narratives, they were documented facts. Backwardation showed up in exchange data. Supply deficits appeared in industry reports. Central bank buying was disclosed in reserve statements. This convergence is what gave his 2026 outlook conviction. And unlike 2025, when his projections sounded extreme, the 2026 targets were simply extensions of trends already in place. The wildcards, tariff rulings, gold revaluation, military operations only reinforced the direction. If tariffs were upheld, deficits continued. If overturned, refunds expanded deficits further. Either outcome favored gold. Gold revaluation would legitimize higher prices and likely trigger a rush into physical metal. Military actions would reinforce safe haven demand. Every branch of the decision tree pointed the same way. Hemke's final observation was perhaps the most telling. Silver's monthly RSI sat at levels traditional technicians would call dangerously overbought. Classic analysis would warn of imminent collapse. But classic analysis assumes silver is just a ticker symbol. It doesn't measure metal leaving vaults. It doesn't account for governments classifying resources as strategic. It doesn't capture stress in a fractional reserve pricing system when the physical base keeps shrinking. That's why he called it a macrocast, not a chart forecast, not a momentum play, a structural assessment for professionals managing capital, for business leaders. Thinking in strategic terms, the message was straightforward. Precious metals were no longer just trades. They were becoming necessities. Governments were treating them that way. Central banks were treating them that way. Industry was treating them that way. The pricing system was adjusting to reflect that reality. $6,200 gold and $120 silver weren't predictions of mania. They were projections of scarcity being repriced in a world where scarcity was no longer accidental but policy-driven. And by Hemke's assessment, that repricing had only just begun.